Hey everyone, this is Mark Treichel from the Governmental Affairs Conference I spent yesterday over at GAC, also known as, and had a good time catching up with credit union folks from around the country, some current clients, some former clients, some trade association folks, some ex-NCUA folks, people still at NCUA, and it was great to see everybody face to face and have some good conversations about what's going on in the industry right now. And I'm going to highlight a couple of things. I've got America's Credit Union's 2025 policy priorities here. I want to mention a couple of those. One of the things that when I was at NCUA, I always participated in and or observed, depending on what position I was at NCUA at the time, was the NCUA board speeches. In this instance, Kyle Hauptman had a roundtable. I did not attend that roundtable, but I did get an opportunity to see his press release from this morning or from yesterday's speech. And it relates to Hauptman's changes to NCUA's overdraft and NSF fee, non-sufficient fund fee collection data. He had hinted, now that I connect the dots to this, he had hinted that changes were coming relative to some of the things outlined in NCUA's priority letter when he attended the front end of NCUA's webinar on NCUA's priority letter. And this is the big reveal. It's good. The short answer is it's good for what he's changing is good for billion-dollar plus credit unions in that they're going to have to report less data. So here's the press release. It says to help ensure credit unions can continue to support the needs of Americans struggling with inflation, the NCUA will no longer publish overdraft and non-sufficient fund fee income for individual credit unions, Chairman Kyle Hauptman announced today. The NCUA will collect the data during supervisory exams, so it won't be in the call reports. They will collect the data as part of the exams. There's a well-intentioned movement aimed at protecting consumers from excessive fees, which is something we all support, Hauptman said. However, we must also consider the unintended consequences of such policies. In this instance, the previous data collection policy incentivized credit unions to avoid serving the needs of low-income and underserved communities. These fees can be the best option in a bad situation, saving money and protecting individuals' credit scores. Overdrafts also protect people from much higher costs imposed by their local governments. Of course, that's the key argument for those on the side of saying that if you restrict fee income, you actually hurt the people who sometimes need to utilize services that trigger those fees. And that is the camp that I am in. I believe that this is a true statement of what Kyle Hauptman is saying. The impact is here. And while not having billion-dollar credit unions doesn't necessarily create a huge change, it's a pivot from a pure missions point of NCUA. It's a pivot from just taking the attraction off it a little bit. Now, they say they're still going to collect it during the exams, and what they previously had said what they're going to do in the exams is that examiners will continue to review credit union overdraft programs, including policies, procedures, disclosures, fees, account statements, member complaints, internal reviews, and websites. Now, of course, NCUA will continue to do that, but they're going to have a smaller footprint because they have a hiring freeze, because the Trump administration's offer to buy people out. I've heard some rumblings on how many people may be expecting that, or excuse me, that may be accepting that. And so we have all this turmoil in federal agencies right now, meaning that everybody's going to have a little bit of a smaller footprint. So they're not collecting this data. They'll look at it during exams, but the exams are going to have a lesser footprint. I think that's net a good thing, meaning that they're probably not going to be digging into this because they're more worried about safety and soundness aspects. And I will always die on that hill that this overdraft fee income is not a safety and soundness issue. And that's a hat tip to previous conversations where I disagreed with current board member Todd Harper back when he was chair, saying that consumer compliance is always a safety and soundness risk, and I think that's a inaccurate way to approach consumer compliance. All right, the rest of the press release, Chairman Hauptman discussed this policy during a fireside chat with Jim Nussle, president of America's Credit Unions, at the 2025 Governmental Affairs Conference. By the way, I did attend Jim Nussle's opening speech, very passionate about the difference between credit unions and banks, very passionate about what importance there is at this GAC to get out and carry the mantra of credit unions, and I'll get into a little bit of that here in a minute. So back to the press release. Under the previous data collection policy, the NCUA required federally insured credit unions with more than $1 billion in assets to disclose separately income from overdraft and NSF funding fees. This data was available to the public on an individual basis and in aggregate. Under the new policy, which goes into effect with the March 31, 2025 call report cycle, the NCUA will collect overdraft and NSF fee data as part of the examination process. The agency will continue to publish overdraft and NSF fee income data in the aggregate once updates to its exam system are complete. They need to change their exam system in order to collect this appropriately. And that's a loophole you could drive a big truck through, meaning that not anytime soon will they report on it, but they will report on it when that's been fixed. With the attack on their budget, I don't think they're going to be spending a lot of money on their exam program just to fix this. So I think there'll be a big pause on reporting it, even in the aggregate. The press release goes on to say, our regulatory framework should protect consumers from predatory practices without depriving them of the financial tools they need to navigate their lives, Hauptman said. The appropriateness of overdrafts and NSF fees charged is a matter between the credit union and its member owners, who ultimately determine how their credit union is run. Amen to that. 100% behind that quote. And I think it's a good change for credit unions, and it's a good pivot for NCUA. Chairman Hauptman also discussed what he calls true financial inclusion, which means removing barriers to de novo credit unions and removing the pain points that have led to fewer smaller credit unions. I think it's great that NCUA appears to be making it easier to charter credit unions, but the reality is that 90%, pick a number, 70%, 80%, 90% of those new credit unions that are chartered failed within the first 10 years. That doesn't mean they shouldn't be chartering them. I think it's great if they could charter. 190% of those failed at a small cost to the insurance fund, but those other 10 succeeded. I think good stories would come from that. Good service would come from that. And so I'm very supportive of that, although I think it's more of a noble mission type goal that it really isn't going to have a whole lot of legs, despite the fact that there has been a slight increase in new charters. All right, the last sentence of this press release, the NCUA must ensure our regulatory burden is not a factor in a credit union's decision to merge away, he said. Once those credit unions are gone, rarely does anyone come to fill their place. Relieving the regulatory burden on credit unions, especially the small and newly formed ones posing relatively low risk to the insurance fund, is vital to keeping those credit unions thriving now and in the future. Again, another noble goal. And I think the pivot away from new regulations, the pivot away from new letters to credit unions, I think is going to be real, and there will be some relief in that. All right, so that's a good thing, and glad to see that he took this opportunity to announce this at GC. In my hands, I have the talking points of America's Credit Unions 2025 policy priorities. They break it into 3 categories: protect, empower, and advance. Under protect, they talk about preserving the credit union's tax status. If you saw on LinkedIn, I did about a 30-second silent video, other than the cars going by, of the ads outside the conference center. Very powerful ad, the way that they approached it. Kudos to America's Credit Unions for that signage outside of and inside and on the handout that I have. But it's a very powerful approach. I think they did a real good job of marketing on that. By the way, the next item is address right-sized rules and junk fees. The Biden administration created the term junk fees, and the Trump administration is going away from that. And GAC and America's credit unions are embracing this. It goes on to say, so legitimate, disclosed, and highly regulated fees charged by depository institutions are not unfairly lumped together with fees in other industries. And that's a great differentiating point as well. Stop the fraud liability shift and focus efforts on protecting consumers and credit unions from fraudulent transactions initiated by bad actors. Another noble goal and item to focus on. This one caught my eye as well. Prevent unlimited NCUA authority by reining in the agency's unnecessary spending and efforts to expand supervisory powers. So under the Trump administration, under the Hauptman-led board, I think that this pretty much takes care of itself because of the spending side of things. The Trump administration is going to shrink the footprint of NCUA, which will reduce the spending. And the expanded supervisory powers, again, under a Republican administration, they tend to be less restrictive as it relates to regulating credit unions and banks. Reform the CFPB structure to establish stability and increased oversight. That's a code word for it's only got one director that leads that organization, and that it should be a board, in my mind, similar to NCUA or the FDIC. But we could see that rolled into Treasury. We could see it rolled into the FDIC, depending on how that all goes. That which leads to their next item under protect, which is support an independent regulatory regime to ensure credit unions' unique structure and commitment to serve their members and communities is recognized through tailored regulation. So this, a lot of chatter with most people I saw at day one, for me, day one, which is Monday of GAC. There's discussions and past podcasts, recent podcast, one with John McKechnie, talked about the risk of Treasury taking over OCC, Treasury taking over FDIC, Treasury taking over CFPB, and Treasury taking over NCUA. And I like the words America's credit unions use here. Tailored regulations for different type of institutions is a good thing. Everybody has their own niche. And by collapsing these all into one agency just because it might save 10% on a budget, I think is unwise. So I disagree with where the administration might be wanting to go here. I think it's very good. By the way, I heard record crowds at GA this year. You hear that a lot, but it's good to see that because if more people keep showing up, if more people hike the hill, you will continually get those folks over on Capitol Hill going, wow, these folks show up, they tell us what they want, and we don't want them voting us out. So we better listen to credit unions. So that's, to me, the best part about GAC, and to see so many volunteers, so many CEOs, so many young folks in entering the credit union movement is a very positive part of this event. All right, so empower, strengthening the credit union difference by highlighting how, as not-for-profit financial cooperatives owned by members, credit unions are consumers' best option for financial services. Never want to lose sight of that. And of course, 100% agree with that. Establish federal data protection standards to protect consumers and small business financial data and hold negligent actors accountable with a single comprehensive national data security and privacy standard. Sounds easy. I don't think it is. I think it's a good idea. Ensure a fair regulatory environment so all financial providers operate under the same rules and that supervised credit unions are not subject to regulatory disadvantages compared to unregulated entities. So that gets into fintechs not being regulated in my mind, and I think there should be some consistency. Although when you talk about nuanced wanting to have separate agencies, you're on a slippery slope with that one when you have that broader conversation. Seek greater fraud prevention through tools to protect credit union members from fraud and hold accountable entities that enable and or commit fraud. Another great and noble goal here on, I almost said CUNA's, on America's credit unions, GAC priorities. All right, advance, build credit union opportunities, expand access to credit unions, create greater lending options and flexibility, allow new investment options, support innovation and emerging technology, and support enhanced consumer access to housing. There's a little bit more detail than those sound bites I just read you there, but again, all of those are noble and good discussions on what the industry needs to advance to enhance the wonderful things that credit unions do for the U.S. citizen. The other item that I came across based on some conversations after I came back and I was looking at it this morning, there's some guidance out there from OPM and OMB relative to agency reorganizations. And in taking a look at that, the agencies, including NCUA, have until March 13th to submit a phase one agency RIF, reduction in force and reorganization plans due to OMB and OMB. Phase two of a plan is due April 15th, and then they have monthly reporting in May, June, and July on progress reports. And then they have a target implementation date for phase two plans in September 30th of 2025. So no doubt the NCUA senior executives are busy putting together a plan that shows that they are taking the administration's desire to decrease the footprint of federal agencies seriously. And I've heard that NCUA has had a decent amount of people take the Trump administration 8-month buyout plan. It's my understanding that just because somebody put a request in doesn't mean that they will get it. So if someone was viewed as mission critical and said, hey, I'd like to get paid to work the next 8 months, and then I agree to leave at the end of the 8 months, but they were viewed as, this is my terminology, mission critical, they might not be allowed to do that. And others who might have positions that are more targeted, let's say they're trying to reduce the footprint of exams or a particular specialist group, or someone who has had mediocre appraisals, I could see those folks getting approved to be someone who departs under the Trump buyout. But in addition to that buyout, they're saying you need to put together a RIF plan. They're saying the agencies need to put together a reorganization plan. The OPM guidance goes on to say that the identification of competitive areas needs to be done by March 13th. Competitive areas has to do with how the RIF will actually work in practice. And there are strategies that agencies, without getting into great details, you can make a RIF area big or you can make it small. And how you do that will determine the bumping rights that people will have. And just thinking out loud and dusting off some of the cobwebs in my brain on this, the more competitive areas you have, the harder it is to have a exhaustive bumping rights. And the bumping rights and RIFs are important in what they protect, but it also means that sometimes when you try and put a RIF in place, it just doesn't make sense to do so, because the only thing that happens is everybody cascades down, all the people stay that are at higher levels. So let's say a regional director job was to go away and they bump down to the lower level below that, they would keep their pay, and then they would bump that person who would go down and bump their pay. So you end up having the higher people stay, and RIFs tend to be generally useless in federal government, but they need to put a plan together. But where it gets more interesting is that they're being encouraged to offer early retirement, which is also known as VERA, VERA. They're supposed to do planning and preparation relative to VERA. They're supposed to conduct impact assessments. They're supposed to review position descriptions, et cetera, et cetera. Then they're supposed to have a RIF notice period, which is 30 to 60 days for people to make their decisions. Then they're supposed to do a RIF implementation. And what agencies can do, they can go to OPM and OMB to get approval to offer VERA and to get approval to offer what's called a VSIP, which is a voluntary separation incentive payment. And that allows financial incentives, which are typically up to $25,000 to employees, to encourage them to retire or resign early, or even if they are eligible, it can be offered. So there's no doubt all agencies are taking a look at this, working on getting their plans in. And you get into this game where you want to show that you're responsive so that you don't have the wrath of OMB or OPM or the White House turn your way. but if you think about it, the pressure points are the industry doesn't want to be taxed. The pressure points are NCUA doesn't want to be merged away. Credit unions don't want NCUA to be merged away. So there is in my opinion, at NCUA would be a general inclination to say, okay, what can we do to take action so as we live to fight another day? And if you just look at, by the way, Doge.gov has a listing of NCUA and other agencies' salaries, and they cut it based on age, they cut it based on averages in certain categories, but they point out that NCUA has 1,230 FTEs, full-time equivalents. If you just look at that number, if NCUA is trying to get down 10%, that's 123 bodies. If they're trying to get down 20%, that's 200 and bodies. They have 1,230. So in order to get down 20%, they need to fall below 1,000 employees. Could that be something that they say that's a good soundbite? We went from over 1,000 to under 1,000? Theoretically possible. 20% is a pretty deep cut, and there would be ramifications of the exam. There would be a ramification in morale. The last NCUA board meeting was all about staff morale. When I look at this OPM guidance that's out there and think about what's going on at the agency and every agency to respond to it, it has a chilling effect on staff. When we're talking about pivoting back to Hauptman saying, we'll look at this during your exam, they're going to have 5, 10, 15, 20%, pick a number, less people doing exams, which means that they're going to be going into less detail. In some instances, that'll be good for credit unions in that they'll just have to not ask so many questions. In other instances, when you're trying to negotiate, when NCUA is saying you need a document resolution, you need an examiner finding, you have an issue here, NCUA is going to be so worried about getting to their next exam, they might not be negotiating as in as good a faith as you need them to so that you get a fair examination. All right, I'm losing my voice because I had a lot of conversations yesterday. I'm about to head over for my day 2, which is Tuesday. If you're there and you want to chat, let me know. If you are there and want to say hi, come on up to me and let's chat about what's going on at GAC, what's going on at your credit union. I really enjoyed seeing the folks I saw yesterday. Looking forward to seeing some folks today and meeting some new folks as well. All right, that's it. Mark Treichel signing off with flying colors.